Welcome, everybody. Good evening, and thank you for joining me this evening. This is a workshop. I think this is the fourth or fifth workshop and webinar I've done. We're getting some good positive feedback on it. My name is Reno Beninati. I'm with the Greenspan Company Adjusters International. We're licensed by the Department of Insurance from state to state as public adjusters, public advocates, otherwise known as private adjusters. And we are a Bay Area company. We're not some out of town or out of state disconnected type of vendor. This is our backyard. And to quickly qualify myself, I have been a public adjuster, public advocate for about 24 years now and licensed in 19 states. Very passionate about what it is I do. We love helping others get the information they need to help themselves. I too was a fire victim. I had a massive fire 25 years ago at my first home I bought, and I have been an advocate ever since, and this is how I got into the industry. So I have been on the other side of the fence, and it is not fun, that's for sure. As a firm, we've been involved in every major wildfire in recent California history. We continue to provide meaningful education to policyholders on how the policies actually respond to the claims process, to the fire when these events happen. Now more than ever, you guys need the information that is critical so that you can navigate through the maze of insurance. It's not something that happens every day to you, and you're suddenly thrust in the world of insurance, and it's problematic for most people. We're able to provide this information to you so that you can help yourselves through, make good business decisions for yourselves and your family. I'm hopeful that after this workshop is over, you'll have a better sense how the policy works, the mechanics, and the way these different spinning plates, so to speak, will respond, and how the buckets of coverage actually interact and so forth. We're here to answer the hard questions, the ones that you really don't feel comfortable sometimes asking the insurance adjuster for whatever reason. And so this is a good opportunity for you to kind of look at this thing from a different perspective, a little more critically. Before we begin the workshop, I do want to mention that you will all be muted, and please mute yourselves to prevent any background noise. I'd appreciate that. As far as Q&A, be happy to answer those questions, but there's a Q&A box down the bottom of the screen, and feel free to type in your questions, and I'll do my very best to answer every question that comes in. If I don't know the answer, it'd be hard to believe, but if I don't, then certainly I can get it for you. The number to reach us on an inbound call is at the bottom of every screen there, or every tab. You'll see slides rather. Okay, so before we begin the slideshow and explanation, I want to mention a couple of things. Number one, if you haven't already, please, please, please order a certified copy of your insurance policy. It is not the way they mail it to you certified. It is a certified copy that comes directly from underwriting, and it's basically the conditions, the definitions. It's the 40 to 80 page document that is the contract language of your specific insurance company. This is a contract, make no mistakes. You've got obligations. They've got obligations to meet. And unless you have the policy, which is really the rule book, you're not in the game. The insurance adjuster may be citing certain parts of the policy to you, and you won't have a copy in front of you to reference. You're going to be at a disadvantage. So look, the adjusters know from the insurance company, they know the policy. They've studied it. They understand how it applies. They interpret it, how it should apply. Sometimes those can certainly be challenged, as often they are. And so, you want to get a copy of your policy. That's really, really important. The policy breaks down into 4 buckets of coverage. And those 4 buckets of coverage are listed on your policy typically as A, B, C, and D. I like to call them buckets of coverage. It's just the way I've been calling it for years. You can call it whatever you like. And the buckets are the A is the dwelling. Bucket B is other structures, things that are not attached to the dwelling itself. Bucket C is the personal property bucket. And then lastly, the loss of use bucket pays for your temporary housing. When the slide comes up, we're going to go in that order exactly, A, B, C, and D, to kind of keep it organized so that you're able to absorb the information more clearly instead of scattering it. Now, if you were to look at your claim in a pie fashion, it would look like this. The big blue section is the dwelling, and that's your basic limit. That's going to be the big part of the claim. It's usually the biggest because the house is the most expensive portion. The teal colored sliver there is the extended limit. You'd be amazed how many people don't realize what that means, but it's in probably 95 to 98% of the policies out there. We find that a lot of people don't even know it exists, and we'll be talking about that when we get to the next slide. The maroon colored piece of the pie is personal property. ACV means actual cash value, and that talks about the depreciated value of the personal property. Again, we'll be talking about that as that slide comes up. Personal property, the red one, RC holdback. RC means replacement cost holdback. Again, we'll be explaining that. The orange colored, or light brown, if you will, is separate structures. Code coverage is the light blue there. The code upgrades talks about, otherwise known as ordinance or law, and that talks about having to bring the new property or the new house up to today's standards, today's codes. The purple is ALE, additional living expenses. That deals with your temporary housing. The green sliver there is debris removal, and debris removal is a very hot topic. You're going to be dealing with it. For those of you that have had the house, completely perish, and then you're going to be dealing with debris removal, and we'll talk about that. As far as the light green, it's trees coverage. So we're going to jump right in to the next slide. Now, each and every one of you that has lost the house entirely is going to be making one of three decisions. Number one is if you don't rebuild. Number two is if you purchase a pre-existing replacement property, a home that's already there with all the landscaping and turnkey. And then the third option you're going to have is you're going to rebuild right where you lost that other house. So those are the three scenarios we typically see. Now, depending on which option you choose will dictate how the policy will respond. So we're going to start with the no rebuild option. If you choose this option, this base limit, we picked $600. It's an arbitrary number. It's just a number we came up with. So we're going to be using this throughout the example as a base limit, because everything kind of shoots off of that limit in the policy in percentages, and you'll see as we go along. So getting back to this, the base limit on this example is $600,000. If it can be proven that the damages to your property that are measurable are over $600,000, then this other coverage called debris removal comes into play. It's an additional coverage only after you're able to exceed and prove that the damages are greater than $600,000. And so that's typically 5% of the limit, of the base limit, and that's how we got to the $30,000. Now, keep in mind that debris removal is part of reconstruction. So what that means is that in an effort to have it become additional coverage, you have to be able to max out that $600,000. So for example, if you lost, if the house is a measurable loss at replacement cost of $700,000, in the depreciation that applies for wear and tear, age, condition, et cetera, comes off of that of $50,000. Now we're at $650,000. That's the actual cash value or the depreciated value. You have now unlocked the debris removal clause, and now you have it as an additional 5%. Folks, you're going to need it because debris removal is not going to be cheap, and I'll be talking about that in a little bit. The landscaping is in the body of the policy as well. You don't see these, by the way, on the declarations page, and this is why I'm recommending that you get the policy in whole, the certified policy with all the pages. Landscaping, they allow you up to 5% for bushes, trees, and shrubs. Some companies pay $500 per tree, per bush, per shrub. Others pay $750 per tree, per bush, per shrub, up to the limit of 5% of the base limit. So in this example, you have an additional $30,000. For those of you that have acreage out there, you're going to hit that number very easily, but you're going to have to count the trees and the bushes and submit that part of the claim. Unless the adjuster from the insurance company says, hey, you're sitting on 4 acres, it's all scorched, here's the money. Now, you don't have to qualify to get that. It's part of the building coverage A dwelling. So unlike the debris removal where you have to unlock it by exceeding the base limit, the landscape money is available up to the 5%, up to the $30,000. That's what you kind of qualify for if you don't choose to rebuild. Now, if you choose to buy a replacement property, there's a few things that change. So the base limit obviously stays the same. The debris removal is the same. The landscaping is the same. What's changed is this endorsement called the extended replacement cost endorsement. The extended replacement cost endorsement is, again, in probably 95 or 98% of the policies out there. The ones that don't have it, unfortunately, are like California Fair Plan. Companies like, I've seen some Guard, Hathaway Berkshire Guard Insurance. I saw a couple without. Another one would be Lloyd's of London, for example. These are surplus lines coverage that will take on higher risk zip codes because of either wildfires, earthquake, floods, things like that. So back to the point, extended replacement cost, in this example, we used a 50% number. Some of your policies have 20%. Some have 25%. Others have 50%, and some have even up to 100% extended replacement cost. Now, what does that mean and how do I qualify is the question. Well, just like the debris removal issue where you have to unlock the coverage, this applies very much the same way. If it can be proven that the damages to your home exceed the base limit, then this door opens up. You unlock this coverage called extended replacement cost. So in this example, we have $300,000, which is 50% of the of the base limit. And so, for example, if you had a loss that was $800,000 at replacement cost to the dwelling, and they knock off $100,000 for depreciation, now you're at $700,000. Well, you've unlocked not only the debris removal, but also the extended replacement cost endorsement. And that's a really critical component to have and to know how it works, because more than likely you're going to need it. Very rarely do we see the base limit of policies actually properly insure for the full amount. So that's why these are in there. They're endorsements that help expand the coverage if you need it. And again, if it can be proven that, that the damages are greater than the base limit. What's important to note is some policies, like a Safeco policy I saw the other day, had an endorsement called a catastrophe endorsement. And what it says is something to the effect of, in a catastrophic zone where it's a declared disaster, which this is, not only in Vacaville, but in Santa Cruz, the policy has an additional kicker, 100%. So instead of 50%, you get up to 100% more. in each category. So it really almost doubles the policy numbers, which is really good to have. Better to have than have not. So that being said, it's usually in the back pages. And again, I think it was CIG has that, and also Safeco that I saw. It's part of a deluxe package that you pay a little extra for. And if you had a great agent, he would put that in there. For those of you that don't have this coverage, like a State Farm or Farmers, then you're going to be subject to the extended replacement cost limit as described in the policy. And you might see it as 150%, 120%. What it really means is 50% more, 20% more above the base limit. And again, it's stackable. It's additional coverage. And that's that next line was talking about that, the declared catastrophe coverage. So next line is code, otherwise known as ordinance or law coverage. The ordinance or law is how it's described in the policy. And most policies have 10% of the base limit for code coverage and up to 100%. Again, you got to look at your policy to understand what those numbers are, because you're going to have to make some business decisions, folks. And based on how this will play out is how you're going to move that money around and how you access it in the policy. So back to code. Code pays for things like, but it's not limited to what I'm saying, but things like sprinklers in the house. By the way, the codes may vary from county to county. So, you got to find out what the code triggers or code requirements will be in your county. And that gets, that has to be taken care of in an effort to rebuild. Or if you don't bring it up to code, you're not getting a permit. So things like fireproof decks and roofing materials, things like low flow sinks and toilets, energy efficiency, Title 24, those are covered under code. So the policy pays for the as was 1 minute before the fire plus code. Now, again, not every homeowner's policy has code available. If you have like a Lloyd's of London, again, or maybe a California Fair Plan, surplus lines, you may not have that. And that may drive your decision to do something else. So it's really important that code is in there. Now, keep in mind, it can vary 10 to 100%, and you have to spend it to get it. They don't just give it to you. The same applies to the extended replacement cost endorsement. You have to perform. That means you have to use it or lose it. For those of you in column 1, the no rebuild column, if you guys decide to just cash out, take whatever you got for a settlement and move to Pismo Beach and sit on the ocean and watch the ocean come in a bungalow that you rent for the rest of your living years, you're going to give up the code money and you're going to give up the extended replacement cost. Now, there's only one company that I saw in the last firestorms pay people without performing. I'm not going to mention who that is, but there is a company out there. Now, I don't know whether they're going to do it again or not, because what we've learned over these firestorms is that it's never the same. They keep changing the way they do things. It depends on the size of the firestorm, the wildfire, and it depends on other factors. So that's what you're looking at if you purchase a replacement property. You're entitled to the extended replacement and code. Now, for those of you that are going to rebuild on site, the same thing applies. You got the base limit, debris removal, landscape, extended replacement cost, and the code. So the only one out of the 3 options that you're going to pick that are a bit of a disadvantage, but again, everybody's got different situations going, so is the no rebuild option. That's what that looks like. Now, before we go on to the next slide, I want to mention something that's, again, critically important. For those of you that have a mortgage, you have to call the loss draft department. It's LOSS as in Sam. And that is a department in every mortgage company. And what their job is to take settlement checks that come in from either fires, floods, earthquakes, hurricanes, and process those checks so that they get back out to you to make repairs. If you're gonna purchase a replacement property, then you're gonna have to pay off the note. So for those of you that are gonna rebuild on site, the way it works is that you notify lost draft that the house has perished and that a settlement check on the dwelling and other structures will be forthcoming when you settle. And so ask them what their protocol is on releasing the funds back to you once the check clears. So here's kind of the sequence of events. You call them, find out what their protocol is. They may send you a package via the mail or on the email, and you want to fill that out, get it back to them, and now you have a file set up at the lost draft department. So when that check arrives, you're going to endorse it. It's going to go to lost draft. They're going to put it into an escrow account, and it will sit there until you're ready to rebuild on the site. What they typically need is two things: a signed or filled out and signed licensed contractor's contract, an executed one, and the adjustment figures. They want to know how those numbers came to be, because here's why they're involved. Everybody's like, always says, why is my mortgage company involved? Well, because they lent you the money to buy the place. So they have what's called an insurable interest, only up to the amount of the note. That's very critical. For example, if you have a settlement check for $700,000 and you only owe $500,000, they cannot encumber the other $200,000, even though their name's on the check. So when the check clears, the lost draft department should be cutting you back a check for the $200,000. That's how it works. So you want to find out how they operate. They're all different. Wells Fargo, Chase, B of A, New Res, Mr. Cooper, Nationwide, they're all different. So find out. And again, that'll help you expedite the money once it's in that escrow account. Because if you don't do it proactively, then you're going to lose 4 to 6 weeks, if not more, processing. Okay, let's go to the next slide. The next slide is other structures. Other structures is any structure that is not attached to your main dwelling. Garages, workshops, detached fencing, retaining walls, etc. Walkways, driveways that get impacted from heat and they spall. Spalling is when it gets so hot outside and the fire's raging around the property that it wicks up the moisture out of the cement, out of the concrete in your driveway, and it renders it brittle. It can no longer function the way it did. That's called spalling, so keep an eye on that. So driveways, patios, sprinklers for the yard, exterior lighting, pools, and cabanas. Again, anything that's detached. Now, typically, the policy will, the limit on the other structures is 10%. That's pretty normal. Some policies have up to 20% of coverage A. That's how we got the 60,000. Now, if you have extended replacement costs there as well, and if you do, that's good. You want to look for it because that'll kick up the number or give you additional coverage with this extended replacement cost endorsement on other structures. Typically, it's just given on the dwelling. But again, there's some policies that have that deluxe feature that also give you extensions on other structures. Debris removal, you're entitled to 5% for debris removal on the other structures. There's $3,000. If you think about the debris field, folks, it's not just the dwelling. It's the retaining walls. It's going to be the driveway if it's been impacted, the fences. So there's other areas of debris. It's not just the house. Code upgrades. Some policies will have a code upgrade, obviously, for the workshop. If you had a workshop, you're going to and you have conduit for the electricity, it has to be brought up to code. So code coverage is also and should be available from 10% up to 20%, I'm sorry, up to 100% on other structures. And that's how we got the $6,000, and that brings it up to $69,000. That's how we're getting these numbers. That should do it on that. That's a pretty simple one. We found that a lot of people in these rural areas have these big barns and these big workshops. And if you had a decent agent, he would have either visited the property, or if you told him that you had these big structures, he would have sold you more coverage under other structures, much greater than just 10%. So I'm hopeful that somehow that happened for you, because we find that a lot of people are quite underinsured in this bucket of coverage. Now, the next coverage we're going to talk about is personal property. Folks, I'm here to tell you, if this isn't handled correctly or properly, it's going to take years off your life. And I'll tell you why. It is the hardest. It is the longest. It is the most personal task that you're going to undertake, because personal property is just that. It is personal. And you're going to be going through that house. If you're going to have to jog your memory. And look, the average house has anywhere between 2,500 to 3,500, if not more, line items of merchandise. When you do your inventory, you do not have to use the one that the insurance company mandates or would like you to use online. You can hand it in on the back of a napkin. Highly unlikely, I'm sure, but you can. So do it in the method that works best for you. If you're just old school and you want to do it on a pad and paper, a pen and pad, that kind of thing, that's fine too. Typically, it's an Excel type of spreadsheet. And what you have to do for you to get paid properly is list every single thing in your home that's gone. That is a task that shouldn't be taken lightly. I'm talking about toothpicks to thumbtacks and everything in between, because the goal here is to maximize the benefit that you're truly entitled to. And unless you're able to get those numbers high enough above that limit of insurance, which in this example is 300,000, we used 50% of the 600,000, you're not going to get all your money. And it's amazing at how many people undervalue what they own, because it could be stuff in the back closet, stuff in the workshop that you haven't used in a long time. So in your mind, it's just not worth a lot of money. But the reality is, it's not what you bought it for, what you think it's worth. You're entitled to collect for what it costs today to replace, plus tax, plus delivery, plus setup, plus warranties. If you bought an extended warranty on an item and now it's gone, you should collect for that. So that's a true picture of what you lost. And you have to do that with every single line item. And that's why I say it'll take years off your life. It is a long process. It is not a sprint. It is a marathon, folks. This whole process of dealing with an insurance company is a process. You know, we live in a high-tech society. It runs really fast with emails and instant information. Insurance companies run slow. You need to prove your damages. You need to make it a defendable claim. If you cannot defend your claim, you're going to be at a disadvantage, because they do this every day. They know how to do it. They know how to process things, and they know how to try to save some money. Look, the insurance companies are a for-profit entity. Doesn't make them bad people, but they've got stockholders that they have to deal with and answer to, and they need to make profits. And so make no mistake, you've got work ahead of you. Everything's negotiable. Every aspect, every bucket here is going to be a negotiable claim for you. So the better you prepare it and present it, the better outcome you're going to have. Now let's get into the mechanics of personal property. The base limit we got here is 300,000, 50%. That represents 50% of the base limit. Most policies are 75% of the base limit, but for simplicity, we came up with the 50%. Now, there are things like sublimits. Sublimits are, if you see there on the second line item, it says BPP. BPP stands for business personal property. And a lot of people that we've run into on these inbound calls have explained that they've got workshops, and they have a woodworking shop where they fabricate furniture, or they make pottery for sale, or art, or what have you. If you earn an income from anything that you're able to on the property, and then you lost it, it's subject to a limit under the business personal property section of the personal property bucket. Most policies are about $1,000 most, or up to $5,000 I've seen. So they're going to ask you questions when you start to take recorded statements or put together your inventory. The adjuster will ask, did you have a business in there? Because you're going to have to separate those items, and they're subject to the limitation. The reason it's in there, folks, is because the insurance company wants to sell you more insurance. They want you to take out a business owner's policy. That's why they do it. So there are other limitations, sublimits like jewelry, cash, collectible items. You'll see it under the personal property section of the policy, in the body of the policy. They're clearly defined, and you might want to get familiar with them. Watercraft or limited, cash, etc. Like I mentioned, those are called sublimits. Now, some of you have items that you wanted to buy extra insurance for. That's not business personal property, but things like jewelry, furs, card collections, baseball card collections, things like that, comic book collections. Those are called scheduled items, and you schedule them. The insurance is on an agreed value. If you lost the item, it is agreed by you and them that that's the limit, and they just pay it. So those are called scheduled items in our industry. In the red box, ACV versus RCV and depreciation, that is, ACV means actual cash value. RCV is replacement cost value. You're going to be hearing these terms quite a lot in the negotiations of your insurance claim. So it's good to get familiar with them, and this is why we hold these workshops, so you can understand how to have a conversation with the insurance adjusters. Depreciation, we'll be talking about that. So on the next slide, you'll see some common questions that are asked often. Do I need to list every item? Yes, absolutely. If you want to hit that limit of insurance, we're going to go back to that $300,000 limit. You would have a claim, maybe if it's now keep in mind, legitimate claim at replacement cost, let's say it's $450,000, and they take off $100,000 for depreciation. Now you're at $350,000. Well, you've exceeded the limit even after depreciation was taken. They pay you the whole thing. They've committed to it. Done deal. You're not marrying the cubicle farm employees in there that are scrutinizing every receipt, because the way replacement cost works in California is like this. This is the definition in California of replacement cost. The replacement cost of an item less depreciation for wear and tear, age, condition, obsolescence, equals actual cash value. That is the definition of replacement cost. So when I say you need to list every item, you should list every item. Because again, you want to get that number legitimately as high as possible, defendably, so that it buffers any depreciation. Now, keep in mind, depreciation is negotiable. It's very subjective. No one knew the condition of that stuff in your house better than you. So you're going to have to provide the adjuster on every single line item, what was the condition and the age of the item. Now in California, you're allowed to not only take the age of the item for depreciation, but also the condition. And I'm going to use an example. I collect old vintage tube amplifiers. I know it sounds weird, but that's what I do. So if I was to make a claim for those old vintage tube amplifiers, the insurance adjuster would say, man, those things are 50, 60 years old. I'm going to pay you 10 cents on the dollar. Well, my response is, yeah, they're old, but they're in excellent condition because I'm a collector. And now they should only maybe take 10%. And I should collect 90 cents on the dollar as opposed to 10 cents on the dollar. So remember that the condition of the items are critical in the calculation of depreciation. I hope that was clear. So do you need to list every item? Yes. How do I list every item? Well, you want to create, where was it purchased? You want to create a narrative. It is really important to create a narrative, a storyline of how you shop. That's going to support your claim. If you don't do that, they're going to price it out at some direct buy warehouse in Oklahoma or somewhere, or some warehouse direct pricing for the similar item, and it's going to be a lot cheaper than if you were to buy it locally, where you maybe support your local business people here in town. So keep in mind that that storyline is important. How much did it cost when it was purchased? That really doesn't matter, because they owe you for what it costs today to replace, plus tax, plus delivery, plus setup, plus. And that's how you calculate replacement cost. People ask, does it really matter? Well, I say to that, everything matters. When it comes to money matters, money matters. So it's really important to list it all. Number 3, what is a holdback and how does it work? Simple. Again, we're going to take, let's say, a couch, for example. You're claiming a sofa, a couch, and that couch today costs $2,000 to replace. And after depreciating it with age, condition, and everything, let's say they take $500 off. You're going to get an actual cash value check for that couch for $1,500. $2,000 replacement, less $500 for depreciation, brings it down to $1,500. Well, the question is, hey, what about my other $500? Well, the insurance company holds it back until you replace it, hand in the receipt, and then they'll pay you your $500 back. That's how replacement cost works. That's the definition of replacement cost in California. So if you can imagine, a year, 2 years, whenever you're making claim for your depreciation holdback money back, you're going to be handing in these receipts to this person who's going to scrutinize everything, and it's a cat and mouse game. And it's a cat and mouse game that you're going to get worn down on pretty quickly, and you're going to lose. I can tell you now, I've been doing this 24 years, been involved in probably over 10,000 fires and claims in general, and it's always the same thing. This cat and mouse game with the receipts. So to avoid that and taking years off your life, I urge you to count everything, get the true replacement cost number up high enough to where even after depreciation is taken, it's above the limit of insurance. It's not an easy task, I know, but it's got to be done if you want your money. Now, the insurance companies have paid out 25% of the limit of contents. Some are paying 50% of the limit of the contents as an advance. Some are paying 75%. And look, make no mistake, that is a strategy move on their end. For those of you that are getting 75% advance against the contents limit, they're smart. They've done the math. They know most people don't want to do all the work, and they'll leave the other 25% on the table. So that's a windfall for the insurance guys. If you don't claim it, you don't get it. And so they also recognize that you're not going to replace every line item of merchandise in your house. You're just not going to. We know that. All the old stuff you don't even use anymore, but it's still there. That stuff you don't replace. So the depreciation on those items, the insurance company gets to keep. And that's why I keep rehashing, get the number legitimately high enough to where it's above the limit of insurance on your contents after depreciation. So these holdbacks are named 3 different ways. You'll hear these terms: full replacement value holdback, depreciation holdback, withheld depreciation. Again, those 3 terms all mean the same thing. It's what the insurance company is holding back until you replace and prove that you've replaced it, then they give you the money. On the sampling. We took a little snippet of a sample of an inventory down bottom. So line 1, women's jeans by Ryder's Vintage. There was 1 pair. That's the quantity. Today it cost $100 to replace. We cost sourced it at Macy's, for example. Again, we're creating the narrative of where we shop or how we shop. The depreciation on this pair of jeans is 50%. And so this person got $50. That's the actual cash value. The insurance company withheld $50. And if this person hands in the receipt that they purchased a pair of women's jeans for $100, then the insurance company will give you the $50. That is a drag. And that's why I say it'll take years off your life. So how do I get my withheld depreciation? We just talked about that. The next slide is going to be talking about tools and tips of how to handle inventory. This is helpful information. Keep a pad and pen with you at all times. Some of you, I bet, have woken up in the middle of the night for some reason or another, and you're thinking about what was in the back closet. Your brain just starts triggering stuff of, oh, I forgot this. I remember I had that. If you keep that pad and pen next to the nightstand, you can jot it down before you fall back asleep so you don't forget it. This helps you. Draw out each room one by one. Visualize drawers and bureaus, closets, including the shelves and drawers. You got to kind of mentally walk through your house again and recall what was in those drawers. Look, the junk drawer in the kitchen, I have a junk drawer. There's got to be about $250 worth of junk in there alone. So don't forget the junk drawer. It adds up. Don't forget what's under the bed, in the dressers, and under the closets, and up above the closets. This one's a really good one. Use family and friends. Let them help you research and price items. Oftentimes, people will call you from across the country, your friends, your neighbors, your relatives, what have you, and they truly want to help. The way you can get them to help is give them about 3 or 4 pages of your inventory and have them price them out for you. That's help. It'll help you, and it'll make them feel good that they are helping you. And that's been a really good one for most people. Next line is photograph documentation and cloud storage. Look, some of you were smart enough to walk, but there was an evacuation ordered, and some people have walked through the house, opened the cabinets, and photographed or videotaped really quickly around the house, and then you leave and you're done, and then the house has perished. Now you have documentation. You can use photographs from an event that you may have had at your home, like a holiday, for instance, and it's not who's in the picture, it's what's in the picture that matters. You look in the background to start to recreate and jog your memory of what was back there for personal property. Not only that, the building finishes. So if your friends have any photos of parties that was at your place, then ask them to dig them up and send them over to you so that you can it'll help you create your list. On the next slide, we're going to talk about the last and final bucket, loss of use. This talks about your temporary housing money. Now, the blue circle is ALE, which stands for additional living expense, and FRV is fair rental value. I just remembered something that I want to talk about. Debris removal, before I forget, very important. So we're going to pause on this loss of use for now. We're going to revisit debris removal. Debris removal is going to be something that's going to be coming up pretty soon. The counties are going to make a decision on whether or not it'll be a government subsidized effort or that the homeowner will have to deal with it on their own. I'm not sure how those decisions are made, but I will say that they don't subsidize it at every firestorm. I don't know what the requirements are, what the thresholds are. Those are great questions for the county people. I'm not aware that they've made a decision yet because there's still evacuation, they're still putting out the fire. So if you can imagine, once the fire's out, then the next monumental task is how are we gonna figure out the debris removal for all these homes that have perished? And here's a really good question, is it all hazmat? Are they gonna issue a blanket hazmat on every lot that everything is toxic to a degree? And it has to be handled in such a way that's very expensive. These are real issues, folks. These are going to be issues that you're going to be faced with. And this is, again, why we talk about it and try to educate you so that you're being proactive and not reactive to the task in front of you. So back to debris removal. If, in fact, do a government subsidized effort, then what will happen is you'll go down and you'll sign up for what's called the program. And the average lot, just to give you an idea of a cost, if you've got about a 2,000 square foot house and it's perished, it's on the ground, it could cost upwards of around $50,000 to $65,000 or more to remove that debris field, put it in the trucks, haul it off to the appropriate dump. It's expensive. Now, if you remember in slide A, the first slide, dwelling bucket, you only have 5% available for debris removal. So if there's a bill that gets generated a year or two later, once they do the work of debris removal, and this bill comes in for $75,000 to clear your lot, and you only have 30 grand or 40 grand, well, hopefully you signed up and that program exists, and they extract the money from the policy that goes to the debris removal people as they deserve. They did the job, and then the government will subsidize the balance. That's how it works. If they decide not to subsidize debris removal, then you're going to be on the hook for it. Now, certainly you have a choice to do it yourself, meaning you subcontract somebody. And if they do a blanket hazmat across the county, every lot is considered hazmat, then you're going to have to hire a certified company to come out and remove the debris. Again, it is not cheap, but if you're on the hook for it yourself because it's not a subsidized event, then maybe you can negotiate the price with the certified company to do the debris removal. I'm just letting you know that that's important to recognize that's going to happen. So it's either one of two things will happen there. I'm glad I remembered that. That was important. Loss of use. Here we go. Back to loss of use, fourth and final bucket. We're going to go down the line of the ALE, the blue circle. Again, it's temporary housing. It pays for that. It pays for furniture rental. If you find a place that's unfurnished, that's your same standard of living, then they'll pay for the rental of furniture for the period of restoration. Increased mileage is covered. A lot of you don't know this, but for those of you that have to move away into 2 or 3 towns out because there's just a shortage of housing, keep track of your mileage, because at the end of this process, it could be a few $1,000s that they owe you under ALE because you're driving extra to the kids' school, to work, to the site. And so there is, I'll refer you to an app that has been really helpful. It's called Mile IQ. And Mile IQ app costs, I think, $5, something like that, $4.99. And the reason it's a great app is because it'll track your comings and goings. It beats having that pad and pen on the dash and having to write down your mileage, because most of us aren't going to do that. But let the computer do it for you. So it tracks your mileage, and then at the end of the day or month, you can swipe one way for whatever personal mileage you did. And because of the fire, you can swipe the other way on the screen, and it'll log and track all that. And it gives you the total miles driven for fire-related issues. And it's a great app. Highly recommend it. It's up to you. So anyway, RV is your recreational vehicles, boat storage. It covers that. Animal boarding. For those of you with cats and dogs, it does cover that. If the hotel is not taking your pets, your animal boarding is covered under ALE. Now, this is very important. ALE, under your policy, otherwise known as loss of use, either has a dollar limit or a time limit. State Farm, for example, has no dollar limit, but it has 24 months. But the legislation kicked in because of all these firestorms year after year, and it bumps it up by law to 36 months. So if your policy says 24 months or even 12 months for ALE coverage, it's automatically increased to 36 months, folks. So that's your time limit. Now, if you don't have a dollar limit, like example State Farm, then your standard of living is to remain the same. That's what it says in the policy. Standard of living is to remain the same. Nothing more and nothing less. What does that mean? Well, if you had a 2,000 square foot house with a pool, you can go rent a 2,000 square foot house with a pool. If you have a 1,000 square foot bungalow, you're entitled to a 1,000 square foot house. Again, if it's unfurnished, they'll rent the furniture for you because you're not going to go out and buy it. You're going to let the policy pay for it under this bucket under loss of use. So the furniture rental, whether it's court or action rental, whatever it is, that they'll rent you the furniture and pay for it under this. So those are for you that have a time limit with no dollar limit. For those of you in the reverse that have a dollar limit, this is really critical to know that once that dollar limit runs out and you've exhausted the limit of coverage, they're off the hook. The insurance company owes you no more, even though you have 3 years. It's subject to the dollar limit. So if you have $100,000, $100,000 in the loss of use bucket, you better do the math because you're going to be out 18 to 24 months at least. Certain counties out here are very slow to issue permits, and it's a drag. So you've got the debris removal, you've got stabilization of land, you've got maybe soils testing to do. There's all kinds of stuff. So it's a process. And so you want to look at that as a budgetary number. Very important. You don't want to run out because for those of you that have a mortgage, you're going to have to pay the mortgage and the rent until you're back in the house. So that's how ALE works. Fair rental value, the green circle, there's policies like AAA, I believe, still have this. A lot of carriers got away with this coverage. And what it says is that they would pay you an amount of money that would be equal to what your home would have rented for in the marketplace today before the fire. So let's say your house would have rented for, just using numbers here, $5,000, and you're impacted for 10 months. That's $50,000. If they agree to that period of restoration, you get a check for $50,000. They're done. That's it. That's how fair rental value works. It's kind of like called a cash out. So if you choose to exercise that option, do the math. Now you could have fair rental value and loss of use or additional living expense in the policy, which they'll pay for the housing either way. So you can either cash out or have them pay for a rental, where you typically will pay the landlord 6 months up front or 1 year up front. That's how they usually do it in these firestorms. And so again, long-term, after 12 months, you're going to have a conversation with the adjuster. They're going to ask, what have you been doing? We paid you 4 months ago, 3 months ago. Are you going to replace the house? Are you going to rebuild the house? Because they want to stop the bleeding in this bucket of coverage. So they like to shorten the period of restoration in an effort to stop the bleeding in that account. Okay, so the period of restoration does come into play. You can't just sit back, folks. If you have the ability and the settlement has arrived and it's a fair and equitable settlement that everybody's happy with, then you need to move with diligence and dispatch. You can't just kick back for 36 months and ride it out and then start building. They're going to shut that faucet off, just so you know. It's important. Okay, I think, and by the way, the carrier owes increased cost due to limited housing. Now, what we saw years ago when these firestorms started happening often, the surrounding rental properties would jack up the rent tremendously because of demand surge. So they put a cap on it. Nobody can increase it more than 10%. But they do owe for it. So if a rental around your area is normally $3,000, they cannot increase it for more than up to $3,300. That's 10%. So they cannot hit you up for $4,500 for demand surge. That they've capped it, and that's good. It helps the people out. Next slide. Who can represent you? Well, the only two disciplines that can represent you by law are attorneys and public adjusters. Now, attorneys handle legal issues, hence the word attorneys. They can negotiate your insurance claim, but I have not seen an attorney roll up his sleeves, get in the debris field with you, and go through that pile. Public adjusting companies do that. So the attorneys are involved, but you don't have a legal issue. You have a valuation issue. So again, you look at it and you make a decision who can represent you. Out of these two disciplines, only the attorneys, again, the public adjusters, are licensed by the state, the Department of Insurance, to represent and negotiate your insurance claim. Contractors cannot, in the state of California, represent you. Please beware of predatory practices by contractors out there that will say you don't need an attorney, you don't need a public adjuster. Let me negotiate your claim. Let me talk to your insurance company. Let me know what your insurance policy has in it. Stay away from that. You're going to need a contractor at some point, absolutely. But less is more. You don't want the contractor to know how much settlement you got, because you can no longer negotiate a number with him. You can no longer, if they know all your numbers, it's going to put you at a big disadvantage. But back to the point, contractors are not allowed to negotiate your insurance claim. You're the contract holder, the policy holder, and you need a license to do what a public adjuster does or an attorney does. So buyer beware with the contractors. Insurance agents and brokers no longer can get involved in the claims process. Senate Bill 488 in 2017 passed, which disallows agents and brokers from getting involved. Look, I get it. Oftentimes your agent is your friend and they want to help, but they cannot get involved in the claims process. They have no influence in it, nor do they have any authority in it, simply because they're an extension of the insurance company. They're selling their product. So it's an inherent conflict of interest. So again, agents and brokers are not allowed. Next slide. This is our contact information. If you had, I'm going to do Q&A next. I'm going to answer some questions, but if you guys think of a question that maybe you didn't think of this evening, you may look over your notes or replay this video, which you can access on our website under news, I believe, the news tab. Feel free to give us an inbound call. The information's there for our number and website. So I'm going to go to the Q&A next here and answer some questions. Okay, this is from Randy Constable. Randy Constable. Is it typical that the insurance companies try to only pay out the balance of the mortgage? No, because keep in mind that typically you're owed the replacement cost value, not the amount of the mortgage. There is going to be an encumbrance. If you have a mortgage outstanding, they're going to be on the check, and the mortgage company cannot hold on to anything above the encumbrance of what you owe them. For again, example, you know, a $500,000 settlement on your dwelling, you only owe $100,000. They can only hold on to an escrow that $100,000, and the other $400,000 should be paid back to you right away once the check clears. So the payout balance of the mortgage has nothing to do with it. You're owed replacement cost. If you have $1 million settlement and a $500,000 note, they can only encumber the outstanding note. I hope that answers your question. Here's another one from Randy Constable. If other structures don't burn down, will they still need to be upgraded to current code? It has to have physical, good question, it has to have physical loss and damage in an effort to trigger that. So if it's not damaged by some singeing or heat damage that you cannot make claim for it, then the insurance company doesn't trigger the code. It stays as it will remain there. If it's burnt to the ground, you have to rebuild it, then certainly it has to be brought up to code. For future references, same person, Randy Constable. For future reference, would a photo album work for the personal property? Sure. If you have a photo album, or if you're saying, I'm not sure I understand the question, but I believe you're saying that if you have, yeah, for future reference, yes, absolutely. But don't keep the photo album in the house. That's problematic. I've seen a lot of that where people say, oh, I documented everything. Oh, where's the documents? Oh, they're in the house that burnt to the ground. Well, that doesn't serve you any good. So if you do have a photo album for future reference, certainly send them off to a friend who's not in a fire-ridden zone. Send them, put it in a bank safe, a safe deposit box, something like that. Anywhere but on site. Randy asks, do I have to make the purchase again, or do I get paid once I prove the contents? Do I have to make the purchase again, or do I get paid once I prove the contents? Not sure I understand that, but if I have to purchase, how long do I have to make the purchase? I see, good. Okay, so I believe it's 2 years. Sometimes they grant extensions. For example, if there's a 2-year period that you're able to collect the depreciation back, what if you can't build for whatever reason? And there's a delay by the county, by the permits, by the whatever. And now it's out to 2.5 years. Well, you can request an extension for good cause in an effort to collect the depreciation on your contents. Randy asks, so even if you decide not to rebuild, they still pay replacement cost? Up to the limit of the base policy limit, only if you can prove that it's damaged to that degree, that the measurable loss is that. And what you leave behind is the extended replacement cost endorsement, and you leave behind code if you choose not to rebuild. Now look, these are business decisions you're gonna make, Randy, at some point. When the numbers hit the table, you're gonna look at everything from 80 feet above, and you're gonna make a decision which way to go. Domingos asks, how long do we have to file lost property itemized claim? And can anything affect that timeline? Look, don't feel rushed. That's a great question. Oftentimes the insurance company will hire an outside vendor. Like there's a company called Inservio, for example. They work and get hired by the insurance company to help you process your personal property claim. And they oftentimes, I hear that they want to move. You emotionally may not be ready to move. So you're going to do it when you're ready. When a public adjusting firm is involved, it gets done in scheduled increments of time, in slivers of time. We recognize that you got to get a house over your head. You got to recognize that there's so many spinning plates going on at the same time that personal property claim is going to be the longest, slowest claim to put together. So I think as long as it's fair and reasonable, the amount of time, just don't feel rushed. Medine, I think I'm sorry if I'm saying it wrong. Medine asks, is there a difference in the way claims are handled for secondary residences versus primary? The answer to that is yes, to a degree. Secondary homes can pose an issue with loss of use. Because if you, for example, if you go to this house every weekend, for example, your second home, and that's now perished, and it was a weekend home, and you have a primary residence a half hour away or wherever, they're going to say, they'll argue that, hey, you really haven't lost too much use of it. So if you want to grab a hotel here and there as loss of use, then we'll do it on once or twice a month because you've lost use of your weekend home. So it does have an impact to a degree. As far as the replacement cost value of the home, it is not treated any differently. Replacement cost is replacement cost. I hope I answered that for you. Randy Constable asks again, I have taken pictures of all my important stuff, each room, and have it with me. Hats off to you, because a lot of people didn't have the chance to do that. So it'll help you recreate your list. It will help you, it'll jog your memory, and it's evidence, it's documentation. Any documentation is good documentation. It will support your claim, period. And that's the way to go. That's the best thing to do. Domingos writes, if a photo shows your item in the background, should you send the whole item or crop out the item? Just send the whole picture. It's there. It shows you in the picture, a relative, and that's it. So yeah, you don't have to crop it. I wouldn't even go through that. If the insurance adjuster has a question, they're going to ask it. And look, here's what they do. Keep in mind that whatever documents you're going to submit on your claim, it's going to be audited. Everything's subject to audit. So the paperwork, the documents, the claim, the adjuster will take it. He's going to send it into corporate. Corporate will look at it, send it upstairs for approval, and then they're going to highlight the high ticket items usually. They don't care about the toothpick or thumbtack, but what they do care about is the items are expensive. $3,000, $5,000, $15,000. Those are going to get scrutinized and looked at, and they're going to try to, they're going to ask questions about that. Maybe they want some kind of proof of where it was purchased or something to substantiate the dollars. Again, they look for the high ticket items. Those usually ring their bell. Patrick Robinson asks, what if I can't prove I had an item? Most evidence burned in the fire. It's okay. Look, you're going to sign some kind of, at the end of the claim, the personal property claim, you'll sign something to the effect of, to the best of my recollection, this is a truthful representation of what I had, but I do not want to prejudice my rights to continue supplementing my personal property claim if I do remember more. And the only caveat to that is if you've already reached the limit, then it doesn't matter. But there's nothing wrong with doing that. There's nothing in the policy that says you have to have evidence of it. It doesn't exist. They're going to count on your ability not to create fraud, because if they catch you committing fraud, you lose everything, not just the contents, the house money, loss of use. It's not good. And have I seen it happen in the past in my 24 years? Yeah, a handful of times. Somebody tried to create fraud and they lost everything. So it's not worth it. Be honest, be truthful, and to the best of your ability, you're gonna put it together. Zia writes and asks, can you talk about looking for discrepancies between your policy and the actual lost property, and trying to get a reaffirmation if you can show the insurance company didn't do due diligence in estimating. For example, my family's policy says they had a 1-car garage, but they actually had a 3-car garage. This is a good one. I'm gonna just get a sip of water and I'm gonna answer that. Well, we have been dealing with a lot of that at these firestorms, where this kind of goes back to what I had said earlier, where an agent sells you the policy and they just keep renewing it, and nobody noticed that the square footage was wrong. Happens a lot. Nobody noticed that there was a barn and a huge workshop on the property, and they never increased the other structures coverage. Does it happen? Yes. For you to file for reformation of policy is not an easy task. I've seen it done actually 2 or 3 times in my 24 years, where the company saw that there was a mistake made by the agent, whether they hit the wrong key when they were entering the data, and you ask for a reformation of policy. Underwriting makes a decision, And if the decision is yes, we'll reform the policy, somebody screwed up. And what they'll do is they'll have you pay a small premium and get the numbers to where they're supposed to be. It's like an act of Congress, because if they do it for you, they'll have to do it for everybody. And so usually there is a lot of pushback. The agents send out a disclaimer every year upon renewal. And it says something to this effect. It's just a boilerplate letter that says, this is your policy. Please go over it carefully to make sure you're adequately insured. If you feel you need more insurance, please call our office and we'll be happy to discuss it. That's a disclaimer. So, you know, if there was a gross error made, an egregious error made, but not intentionally, people make mistakes. That's why there's erasers on pencils. If there was a mistake made, that's to be considered. If it goes down the avenue that you may need legal advice, then maybe you go that route to have the reformation. If you strongly feel that the agent made a mistake and he's saying, no, it wasn't me. Look, agents have errors and omissions insurance for this very reason. So there are some avenues of recovery. And I got to tell you that it can make a big difference whether or not you're going to rebuild or move or what. Because I saw a policy today that needs another $300,000. And we're going to request a reformation. Where it'll go, I don't know. But it's worth a shot, because this is going to make a difference of good recovery or just average recovery. I hope that answered your question. Next question. I'm not even going to try and pronounce the name. I'll hack it. How do you value an item such as an antique that you got from family members and you don't know the brand, etc.? Great question. In the insurance world, an antique, the definition is 100 years or more is the age of it. Now, is it a Victorian piece? Is it an English Tudor style? What era of antique was it? It does not matter that the family member gave it to you or that a family or a friend gifted you something. It's yours and you're owed to the cost to replace it. So maybe you get online and you do some research for that antique, something that looks very close, if not identical, period piece and the same type of structure in wood. Then maybe on a Sotheby's or Butterfield's, these websites that do auctions for antiques, the Antique Roadshow, those kind of shows. There's a lot of data online. And, you know, we're kind of lucky we live in the age we do because years ago, can you imagine without the internet trying to find the information to substantiate your claim? That would be 5 times as hard. Patrick Robinson writes, what percentage of claims see a full payout of policy limits? Looking to set my expectations for both main structure and personal property. Great question. If you get the full payout of the policy, including the extended replacement cost that they commit to if you're going to spend the money, the personal property's been paid out, what that tells me is that you were grossly underinsured. That's what it tells me. So it's not a percentage. Look, you could have a limit on your building, your dwelling for $1 million, just using round numbers. And when they measure the actual measurable loss, a defendable loss, maybe it's $850,000 at replacement cost. You're good. You've got plenty of insurance. But if it's the opposite, if the measurable loss in this case is $800,000 and you only have $600,000 in coverage all in, they're gonna commit to the whole thing. You're underinsured. They win. Personal property, same answer, same thing. If your list comes up to $500,000 and you've got a $300,000 limit, they're gonna pay it all. It's easy. But they may advance you a little bit in the hopes of either you forgetting 20, 30% of the list, or you just get lazy and say, I'm done. I'll take my 50%. So again, you know, and the other caveat to that is, and I've seen cases where you have a 4,000 square foot house and you've got a limit of maybe 400,000 or 300,000. It's safe to say that you've got a lot of stuff in that house, and sometimes they just pay the limit. It's all over the map. There's no formula. It's all negotiable, It's all in how you present the claim. You have to prepare it, present it, and negotiate it. I'm going to just call it D. D asks, what if it is such as a hutch built by your dad? How do you value that? That's a great question. Well, I ran into a family who builds their own furniture. Talk about how do you value it? Well, here's the answer. What would it cost for you to hire a craftsman to build that piece of furniture, just like it was? That's your answer. That's what they owe you, replacement cost. I know for me, it's simple because I hear this all the time, but that's how you value it. The sentimental value does not come into play, folks. They don't pay for that. It's not in the policy. They pay what is the replacement cost today. By the way, replacement cost of your dwelling and your structure has nothing to do with real estate value. I just had this thing in my mind. I just remembered a lot of people always combine the two. It has not, they're completely different, okay? So real estate value and replacement cost value are separate. Painting is the same. Dee asks, how do you value something, a hutch built by a family member or a painting of the family? I've seen a lot of that where you have, you go out and hire an artist to paint the family, or they'll do a rendering of the family. Well, that's got sentimental value, but the cost of the frame, the cost of replicating that painting is what the value is. Zia asks, if you are able to inventory all of your positions and get the total up the covered amount for loss of property, including depreciation, is the provider liable to pay you more than your policy limit for that category? No, that's why they're called limits. Now, if we're talking about personal property, if you have a $300,000 limit and your list is $500,000, and even if they take $100,000 off of depreciation, now you're at $400,000 after depreciation, and you have a limit of $300,000, that's all they owe you. Unless you have that deluxe endorsement like Safeco or CIG in the back of the policy, which says that 300 is now 600, and they increase it by 100% in a declared catastrophe. So look for that. That's why, again, every policy is a little different. But that's a great question. Anonymous attendee, how does it work if we want your company to handle this? Do I still have to do all this work? It feels like they are burying us in nonsense and it's scary. Yes, you're right. It is scary. It is nonsense. But folks, you're making a claim to the insurance company. They are not making a claim to you. You have to prepare it. You have to take the position of it's your money. They're holding it, but you have to prove why they owe it to you. It's the law of indemnity. You're owed pre-loss condition, which you had a minute before the loss occurred. So to answer your question, how does it work if we want your company to handle this? We're looking at everything, folks, on a case-by-case basis. We cannot solicit you. By the way, while I'm on this, if you get an inbound call from a public adjusting firm 7 days prior to the evacuation order being lifted, they're in violation of the law. This is very important. If you call us, no problem, we can talk to you. We cannot call you. There's a moratorium. So again, if you're getting an inbound call before that moratorium is lifted, then you should report that public adjusting firm to the Department of Insurance in Sacramento. So to answer your question, to handle this, we're looking at claims on a case-by-case basis. It has to be where we add value to the process. Very important. We're getting a lot of calls for smoke losses. It doesn't make sense. They're using us as a resource for information like this evening's workshop. But if your house is burnt to the ground and you have a decent policy to work with, maybe it's worth a conversation to talk about if we can add value or not. If we impact you negatively, we're going to know it right away because we look at the numbers all the time. A good public adjusting firm will look at it critically and say, yes, this makes sense, and here's why, and here's where we can add value to the process. And so, give us an inbound call, and one of my associates or myself will call you back, and we can have that discussion one-on-one. I'd be happy to do a policy review at no cost, no obligation. Catherine Wilson writes, when asking for a certified copy of the policy, is an electronic version okay, or should I insist on a hard copy? Well, I saw one. That's a good question. I saw one the other day come in via email from Safeco with an affidavit attached, stamped and signed. So that's okay. You can always print it. But if it comes in quicker, because it takes 2 weeks to generate a certified copy anyway. So it's important to recognize it's going to take time from the point that you order the certified copy to the point that it comes in the mail. 2-3 weeks go by. So if it comes in via email and they have it like an affidavit attached to it that's signed off by somebody in underwriting, and you see the seal, that should be sufficient. What do you charge? Somebody asked. We work on 10%, 10 cents on the dollar of what we collect. And again, we have to add value in an effort to get involved. We have different fee schedules for commercial losses. Again, we look at everything on a case-by-case basis. House fires and wildfire storms and these types of claims are 10 cents on the dollar. We get paid on a contingency, meaning if you get zero, we get zero. The public adjuster gets paid on the back end of the claims process. Zia writes and asks, it would seem so far in our negotiations with farmers that they are willing to pay out 24 months worth of loss of use costs, living expense, without wanting any proof of purchase, receipts. Paying out, paying out in 6 months increments for 2 years, no questions asked. That's what they should be doing. That's good. They're willing to pay out 75% of our total amount for loss of personal property without any documentation, but they may want documentation if we were to try to collect the additional 25%. That's correct. So farmers right now is doing that. They're giving you 75%, Zia, for the contents, and they're hoping that you won't go back for the rest of it, and they get to keep 25%. And let me tell you, at some of these claims, that could mean $100,000, $200,000 that you're leaving on the table. And look, if you're lazy and you don't want to do the work, that's your decision. But let me ask you something. Ask yourself this. Under any normal circumstance, if I told you that I would pay you $150,000 for doing part-time work for the next 4 or 5 months, what would the answer be? You'd say, yes, I'm sure. So that's how to look at it. Reframe your thinking. So that's a strategy the insurance companies use. They're hoping that you don't come back for more. As far as your living expenses, yeah, that's good. They're stepping up, and they should do that. Your standard of living is to remain the same, 6 months, every 6 months they renew. Perfect. At the end of that 2-year period, but I think, no, strike that. Probably in 12 months, they're going to have a conversation with you about what your plans are, and if you're going to move forward with rebuilding or replacing the property. Because again, they want to shorten that period of restoration to stop the bleeding and loss of use. Let me continue on. Also, they don't seem to want any documentation in order to pay out for external structures or debris removal. Is this normal? Yeah, that's just telling me that your other structures coverage, Zia, you're underinsured. If they're maxing it out, like we talked about a few minutes ago, then that just tells me that you're underinsured in that category, and it's a no-brainer. So they just pay it out. It seems to be at odds with what you're describing of it being a knife fight to provide documentation to get these things. Look, you're with Farmers. Farmers has decided to do what they do. Each insurance company is not like Farmers. I will say that Farmers, while we're on the topic, were the only ones up in Santa Rosa and some of these other firestorms that stepped up to the plate. They paid people the limit plus the extension, if I remember correctly, plus code, if I'm not mistaken. And they were the only ones that did that. Every other insurance company said, no, we're not going to do that. We're going to go through our normal claims process. Is it a knife fight? No, it's a negotiation. It's not a knife fight. But you're lucky you're with farmers, because right now they're doing the right thing for you, and that's good. For those of you that don't have farmers, look, there's a lot of insurance companies out there, guys. There's AAA, Travelers, the Hartford, Nationwide, Safeco, Liberty Mutual, Farmers, State Farm, and on it goes. Lloyd's of London. They're all different. And the way they do business is differently. The way they pay advances are different. The arguments are different. The negotiations are different. They're all different. Catherine Wilson asked, do I order it from the adjuster? I suspect you're asking about the certified copy. Yes. Yeah. And put everything in writing, by the way, real quick. If you're talking to an adjuster on the phone right after you hang up, memorialize it. Get on the keypad. Send that person an email that says recapping what you talked about, and get a confirmation. Do not text the adjusters. A lot of these adjusters are from out of state. They're going to come here for a little while and they're leaving. They want to go back home, and then they'll reassign another one, and then another one. Oh wait, and then another one, and another one. So if you're texting, there's no documentation in the corporate system, you're going to be at a disadvantage if something happens, because usually the fifth guy doesn't agree with the third guy. The fourth guy didn't like the first guy's valuation methods. It becomes problematic. So remember, all communication should be on an email. They hate it. Do it. Trust me on that one. It's important. Jill Collin writes, or asks, if you don't rebuild, don't have a mortgage, are you still on the hook for the debris removal? Yeah, you are. It's your lot, and you're going to be subject to clean it, because think about your neighbors downwind. Think about right next door. That stuff's going to be blowing all over the place. And look, we're in California here. We're not in the backwoods of Kentucky, where you can bury it in the backyard. Maybe dig a big ditch and bury it. You can't do that. So yeah, you will be on the hook for debris removal. If you buy another home, how do you prove the code? Pretty easy. If you buy a home to replace the one you lost instead of rebuilding, you may buy a home that the kitchen was not what you had. And so you can increase the dollars there under the extension and bring that up to code. The bathroom may be older and it's not as good as you had. That's how you do it. I'm going to go into the chat room. There's a couple of questions there. Let me see. Okay, from Karen Villalba. If we do not rebuild, will they still cover debris and landscaping losses? Yes. Yes. And yes. Yep, those two. That's a yes, Karen. From Randy Constable on this side is this is good information. Very glad I attended. Thank you for attending. Look, spread the word. We're here to help. This is our way of giving back to the community. This is our backyard. I too was a fire victim, and I'm really passionate about getting people the information that they need and deserve in an effort to get back on their feet. There's another one here. Another question: is there a difference in the way claims are handled for secondary residents? Nope, we answered that. I think these have been answered. Yeah, those were answered. I think that's it, folks. I think I've hit the last. Yep. Last question. I want to thank everybody for being here, and look, tell your friends, tell your neighbors, tell whomever that could use this information. Tonight we covered mostly total losses. You're welcome, Jill. Is it Jill? Yeah. And tomorrow night we are covering exclusively, without the slides, smoke damage. There has been an incredible amount of calls to our office regarding smoke claims. Really, really important. There's a lot of a gray area, we'll call it, that needs to be discussed. On board, we will have an environmental hygienist to lend an opinion of how that works and what they do and why. We'll have some expertise on the definition of smoke and how it exists in the policy and how it responds. Civil authority versus full-on loss of use. So tomorrow night is going to be that. So for any of you that have a neighbor or somebody that you know that house did not perish, please let them know. It's at 6:30 tomorrow evening. Again, thank you for attending, and good evening.